So everybody, thanks for joining us today. I'm Terence, and then I'm TUBInvesting as well. You guys will probably know me. Okay, so today I'm just going to share on what I've researched on for growth investing. After I share finish, then probably we'll have some Q&A, and after I share finish, probably we will have some Q&A. Then you all can ask some question. Okay. So for now, I think John will assist me on the admitting of the people. So I will just continue with my presentation. Okay, so why did I maybe for a start, I was a value investor, so this is very new to me, growth investing. So I as always, I will always go into some research and then try to understand what is happening, what people are doing for growth investing strategy. Some of my influencers are members from the Telegram group, such as Cavester, XH, and then I've also researched on Peter Lynch, Phil Fisher, Ken Fisher, and then Warren Buffett. So there are some influencers from these gurus as well as the members from the Telegram group. So why did I change from a value investor to one that is of a growth investing? I believe that in the current investing climate, right, we have to come out of our comfort zone for value investors, because if you intend to invest in US right now, the company that's getting listed are all loss-making companies, and then many of them are are in the technology industry. So since many people are making losses but their share price continue to gain, we need to use a different technique to invest in this US climate, especially when this COVID-19 situation arises, right? If we continue to invest in continue to invest in value firms, right, that actually that's actually NCAV companies, right, you may not be able to achieve the capital gains that you're looking out for. So that's why I came out of my comfort zone. And then one of the main thing is if you realize after that, for my growth investing strategy, right, I actually include the value terms or value terms in the I actually included value terms inside this growth investing style. So you all can later ask me about it as well. Okay, so before I start on everything, right, I want to start that I actually had this money flow concept, or last time I used this to explain the free cash flow concept. So when a company earns revenue, it goes all the way down to the profit, and then after that it goes into the cash flow, where the net profit will be here. Then you will deduct then you'll come up with the net cash from operating activities. Then after that we will deduct the capex. Then you will go back into the asset. So when you look at as for value investing, right, normally we look at balance sheet. So you buy a company that's worth $1.50. So if the balance sheet is worth $1, then we are buying at 50 cents. So that's the main theory of value investing. However, for growth, right, I don't think people are looking at the balance sheet or the cash flow. People are more looking at what's happening to the revenue, and what's after that what comes later. So the main theory of growth company are all focused on the revenue. So as you can see, this money flow concept is the same. So from revenue, as you increase your revenue, you try to reduce the administrative costs along the way, right? You will eventually achieve achieves value within your company itself. Your balance sheet will eventually grow as well. So for growth company, the main focus is eventually on revenue, and then that's how. Okay. Okay. So for the money flow concept for growth investing, I focus a lot on revenue because whatever will comes later. For example, operating activities, uh, operating expenses, right? It can be reduced through other technology implementation in the company. So all this will actually happens on the later part. So I'll just be very direct and I'll just cut short all the explanation. If you can ask me later. Um, so revenue, some of the criteria for my growth investing strategy is simple. Revenue must be growing. So it must have the historical growth. The revenue must be growing historically. And then depending on your own expectation, it could be 40% growing annually, or it could be 20% growing annually. It's eventually up to you. Okay, just FYI, my daughter is crying crazily right now. So if you all hear crying noises, it's my daughter. I'm trying my best to have a good presentation today. So okay, I'll ignore her for now. So just FYI, if you all hear a crying noise, it's my daughter. So anyway, for gross margin, I'm looking at more than 40% because eventually you will want your gross profit to be converted to net profit. And then you must have a significant gross margin eventually to allow your gross profit to be converted. This is something 40% is a theory that I just use simply from extracted from Buffett. So I believe he has a theory on gross margin being 40%. So that's how I see it. However, you can increase your gross margin criteria as well. It can be 50%, 60%, 70%. It's all up to you. So this is just a guideline, I feel. I also look at total addressable market, TAM, and then normally companies will emphasize, growth company will emphasize on their TAM. Okay, that's how I see when they do their PowerPoint on the investor day. They will try to emphasize that their TAM is very huge. I mean, take it with a pinch of salt. For investor, for us, probably we should see whether this TAM is it really their actual market itself. However, if you look at a TAM, right, it can be so huge, but based on the company's revenue, right, for a company to grow, the TAM must be high. So the revenue, I'll give it a breakdown of probably it should be less than 10% of the TAM itself. So that's how I see it. And then I'll prefer no dividend. This is something I think Calvester actually last time shared as well. He prefer company that has no dividend. So I also take in this criteria. I think this is quite important because we prefer a company to reinvest their profit for future growth. One of the main thing I also in this research I've done is that I need to do this research on tech companies and tech firm. But the interesting thing is I also find tech companies that's in non-tech industry. So for example, I recently talked about T.U.B in the group chat, right? I feel that it's one of the tech firm that's not categorized in a tech industry, but it's categorized in a non-tech industry. So this company tends to have tech firm style ratios in a non-tech industry. And when you look at that, right, you as an investor, you must understand that other investors are looking at this company from a tech firm style. That's why their ratios tend to be outliers from the other from their I would say from their competitors within that non-tech industry. So however, if these tech firms, which you deem them as technology firms, that's in this non-tech industry, that's having not those tech firm style of ratios where they are supposed to be very high PS, high PE or in losses, right? Then these are probably things that I assume these are probably things that as an investor should catch your eye, and then you should dig deeper into these companies. I think Sheheng also has added, we have this discussion on the group chat as well about value proposition by SAS company. So basically a value proposition given by this company that provides a service as a solution to their clients, right? This value proposition must ultimately benefit the ultimate beneficiary of the of this solution of the users basically. So for example, I go back to 2U. 2U provides a platform for university to teach their in simple terms is a platform for the university to teach or to market their courses to the public. So the public the public or student must be able to benefit from this value proposition. I mean, why choose online course rather than go to the university, right? So as an investor, you must be able to see where is this value proposition of this solution itself and how it can ultimately benefit the ultimate user. So that's one of the criteria. And then another point is that the company you must understand how the company earns its money. This is also, for example, when a company, similarly, when I talk about tech firms, most of them are most of them provide a service as a solution product. So when you must understand how does this service as a solution product earns money for the company. It can be goes via recurring money fee. It can go via pay as you use fee. So if you use probably some of these things will happen where there will be a recurring fee, then there will be additional pay as you use revenue that's being earned. And another point is I only look at mid caps and below. Mainly why mid caps is that I believe that when companies grows beyond mid caps, right, it's harder for them to grow their revenue, grow their business. You must be able to look at them from a macro point of view already. So if you want to see growth company that can really keep growing, right, probably from mid caps and above. This is just a point that I have. So so I'll go into PS ratio. So as a start, I said that I'll focus a lot on revenue for growth investing strategy. But at the end of the day, I'm still a quantitative investor at the end of the day, and then that's why. And then I want an understanding of what is the fair value for my company. So since that I have a focus on revenue on this growth investing strategy, I decided to look at the PS ratio. Okay, this is a ratio that made famous by the Fishers. The father is Philip Fisher, the son is Ken Fisher. However, when you look at PS ratio, right, I think John also brought up something to me when I shared this with him. He said that he don't know whether how good is a PS ratio calculating a fair value. One of the thing I think that when we as investors talk about valuation, right, we are looking at it as a guide to a destination, to a destination. However, this valuation should not be the definite destination of where your company will be. So for example, I have a share that's priced at $5 currently. I buy it at $5. I believe that it will grow until my valuation calculation goes state that it will grow until $20. However, along the way, right, it could grow until $8 or it could go until 10 to 15. And then things along the years may change. The company may change, and then the direction may change. So we must recalibrate it, and then probably 15 is something that is a good fair value at that point in time. So that's what investor must know, that when you look at valuation, it's not a destination, it's a guide. You should only use it as a guide. Uh, so I actually wrote a piece on valuation on my blog. I said that valuation is a fake motivation number. You can make it as high as possible. You can say that I can say today Facebook is going to rise until 500 in 3 years, $500 in 3 years. But then I can come up with uh, numerous reasoning on why it will rise until 500. But to me, that is just a guide based on what I have to support my guide. But it may never rise to $500 within, I don't know, maybe within the next 2 to 3 years it could. Maybe in the next 10 years it will be $500. We never know. But that's how I believe we should use ratios, especially when we go and calculate valuation. So okay, I should show my research that I got from the Finviz data. Okay, can you all see my screen now? It's supposed to be Excel. Okay, there's can you see this, right? If y'all can't see this Excel screen, please talk to me. Okay, I assume y'all can see my screen right now. Okay, this is the research that I've done on the screener, FINVIZ, this US screener. So if you see this large cap, the PS ratio, this is solely on PS ratio. The price to sales ratio is for the large cap, it's not very high. It's not at those like 20 to 30s level. It's always, it seems like you'll always be around 10, or 10 or below. And then for this mega cap, so if you look at the whole mega cap itself, right, the highest is only 18. But if you look at a large cap, right, the highest is about 50.67 PS ratio, and if you look at mid cap, it's about 38. And as you go down, right, the ratio probably gets lower. So that's how it goes. So what I want to say is that PS ratio may not be a very good indicator for growth investor when you look at mega cap or large cap company. That's why when I look at PS ratio just now, I said that I am only focusing on mid cap companies. So let's move on to what I found out. Okay, so for this quadrant, right, I look at US tech firm. The sales is on a quarterly basis growing on 10%. I look at only mid cap. So the mid cap companies between this that suits this criteria is about 63 companies. The medium is about 8, PS ratio at 8. The first 1/3 of the company is about 12.5. Then the final third, the highest is 6.5. So, and then the maximum I have a rough gauge is about 18 to 22. So probably we can give ourselves a 20x PS ratio is a good gauge for a maximum fair value that a company could probably grows to when it's having a quarterly sales growth of 10% within a tech industry in US. And when I say US, it excludes all the China firms that's listed in US or the overseas firm that's listed in US. I solely look at the US firms. So if you look on the other this quadrant, I look at the small cap. US, similarly, companies in US, listed in US, within the technology industry, sales growth is 10%. I look at small cap below 2 billion, and then there are about 95 companies. So the PS ratio for this is about 3, the medium. The top 1/3, the lowest was 4.8. The final 1/3, the highest 1.6. So if you look at this, the differences between the mid and small cap, right, you can see that the PES ratio is actually very different for these two group of companies. This between mid cap as well as small cap, and the difference could be investors are less riskier on companies that that's having a smaller cap, and they don't believe, and because it's a PS ratio, right? The sales, they don't believe the sales could grow as fast as a company in mid cap. So people probably do not want to invest, believe that this small cap company will be able to grow into mid cap. It's similar to our Singapore investing in Singapore market, where catalyst sometimes is not able to have higher ratios. It's not able to achieve higher ratios than those blue chips, or than those mid-tier companies, like for example, compare AEM versus another company that's in the same industry, that's in a catalyst. So that this is probably one of the reason. So I did another research. Similarly, tech firms US, but now I lower the quarterly sales growth to 5% for the mid cap. So if you look at this point, previously was 8 when the quarterly sales is about 10%. Now it's about 6.9, and then the highest is about okay. So for the first one, for the top 1/3 of the company, the lowest was 9, PS ratio at 9. Previously was at 12.5, and then now the final quadrant, the highest was 3.8 only. Previously, when you look at the 10%, it's about 6.5. So if you compare these two, when I drop the quarterly sales to 5%, right, it actually shows a lower PS ratio. So this do shows that growth in sales, the revenue growth is directly related to PS ratio. So the higher growth, if people assume that this company will have a higher growth, the PS ratio could be higher. So that's one of the things that I found. Similarly, when you look at the small caps, it also reduced. The medium went to about 2.4, from 3 to 2.4. The top 1/3 quadrant went from 4.8 to 4.4. The final third quadrant, the highest went from 1.6 to lower to the lower, like 1.3. Okay, so with that, I concluded one point, which is growth in sales will directly affect the PS ratio. Lower growth, lower PS ratio. Higher growth, higher PS ratio. Okay, when this growth I'm talking about is that when a company constantly or when the expectation of the growth is supposed to be the same, like if a company grow 50% this year and you expect it to grow 50% this current year, then it will then you give it 50%. If it's 50% is high, then you give it a higher PS. So it's an expectation growth. It's not a constant growth. I hope I'm clear on this. You can ask me question later on this. Okay, so I also share the PS ratio across different industry. If you look at healthcare, it's one of the highest. It's one of the industry that has high. People expect high growth. It's a high growth industry that people expect the revenue will keep growing and growing. So if you look at their medium PS ratio is about 8.5, where you compare to the technology sector is about 8. So it's still slightly higher. Healthcare industry is slightly higher than technology in the industry. And when you look at communications services, which includes some of the telcos, the medium drops to 4. So that is one of the things I think we should know as well. And if you look at industrial, the PS ratio median actually drops to 1, and then the quadrant for the lower third is the highest, only 0.5. So other than growth, right? Other than the expected growth, right? The industry also affects the PS ratio. So when your company is in a certain industry, or it comes out and says, I'm a tech industry, it will command a higher PS ratio. When a company say that I manufacture, it may command a lower PS ratio. So that is one of the things I also found out. So let me go back to the slides. So basically what I want to say is that from my research, I realized that PS ratio is affected by the industry the company is in and the expected revenue growth rate of the company that their sales will be expected to grow moving forward. Okay. Okay, then I will show another Excel spreadsheet now. Okay, I hope everyone is listening now. If y'all cannot see this screen, do talk to me about it. So I've actually created a valuation model. I said that I'm a qualitative investor, so I always likes to have a valuation model to give me a fair value of where the company is going, and I believe this is a good guide for me to understand the margin of safety that I have, and also to understand what is the bottom that I should be expecting for this company. If it goes below that, then probably I should do more research on it. So similar, I'll just key in the year here, then I'll just input the revenue. Okay, all these sources, right, you can just get directly from where's this, Morningstar. Okay, it can be copied directly from Morningstar. I created this version so that I can take the data from Morningstar directly and input it. So it's very easy to use. I can share it later in the group chat. Anybody who is interested can PM me for this valuation data. So what I was doing for this company, right? So the last 3 years revenue is about 34 million and 34 million. Then in 2019, it grew until 40 million. So I want to see whether if it continues to grow, what is the high growth revenue? What is the if I assume it grows at 30% per year, then this is the revenue. If the required growth, I believe, is about 15%, then this is the revenue. So if you can see this is a very subjective or relative valuation model where it's up to each individual investor expectation of the company. So how I normally do is I just key in some of the growth rate that I believe the company, if it grows at 0%, because the growth rate will affect the PS ratio directly. So I give it a lower PS ratio, and then the expected share price is this, and then as per now the share price is $10, so there will be an expected downside of 77 if it grows at 0%. The reason why I do this is that I remember Calvester said something on growth rate. So he said that if you calculate wrongly on the growth rate, right, you may not, the fair value may have changed, or you may need to redo rebalancing and stuff like that, and then you need to re-understand the company. So it's like a growth rate is a fundamental factor, and if you calculate it wrongly or you deem it as a wrong factor, right, you should re-look into it and then recalculate to see whether does your fair value make sense. So that's one of the things that I did this valuation model out for. So let me go back to the slides. Okay, for the valuation model, if you all get any question, we can talk about it in the group chat again when I share it around if anybody is interested. Okay, so why did I look at 3 years data as only one of the main factors? Because Peter Lynch once said 3 years, 5 years, you don't look at company immediately, you look at least 3 years later. So I look at 3 years of revenue growth for my valuation model. And then, as I said, it allowed me to focus on the downside, right? How much, if the company doesn't grow at this rate, or if it grows at a lower rate, where's the bottom for the share price? So that's how I calibrate this valuation model out to allow me to understand what's the downside for this company when I invest in it. The general guideline that I have right now is that for tech firm, when I invest in it, the PS ratio should be about 6. The maximum I think should be about 7. This because if it commands a higher PS ratio, right, that means I'll be expecting the company to grow more. And any decrease in the growth significantly could cause the share price to be lowered very fast. Like for example, for FYI, Datadog PS ratio is at about 50 currently, and it's growing at about 89% per annum. If it doesn't grow, imagine if it drops to 30% next year, what's going to happen? People will have a different expectation of the company, and people will sell down the company, and then technically the PS ratio will be affected after that. So that's why I only look at when I invest in it and I understand the company, that at that point in time the PS ratio should be about 6 or 7, so that it gives me a buffer to allow the company to grow. Yes, then finally treat this model as a guide, and then focus on the downside if a company is unable to achieve the growth. Okay, I'm done.